Good afternoon, Jax. This is Fahad. I want to take a look at Edgewell Personal Care, symbol EPC, Edgewell Personal Care. As usual, we are going to evaluate the stock based on the same three-prong approach we use all the time, the fundamentals, technicals, and unusual option activity. So first, let's take a look at technicals. Now, here's a chart. This is the daily annual chart or yearly chart. If I turn this into weekly, you're not going to get a very good picture. The simply reason is that it does not go further back than June, July of last year. That's because that's when the company was spun off. So this is the chart. Basically, on a larger scale, what you have is a long rounding bottom. So it was coming down, making lower lows, and then it finally stopped making lower lows, and now it's making higher lows. And I'm expecting this to break out from here. My first target, again, always focus on these volume over price resistances and supports that I lay out. My first target on this beautiful candle that's in front of us is right here. This is the volume over price resistance that's going to come into play around 85.40 right here. So that's about 4%, 3 to 4% to upside from here. So it's going to come into play right around here. But based on certain catalysts that I'm going to talk about and the earnings that are coming up, if the stock breaks out from here on pretty good volume, this will open a big air pocket all the way up to 92.60, which is way up here. So you're looking at a pretty good, air pocket coming up all the way up to 92. But let's see first if this can actually clear this congestion area that's coming up to 85.50, let's call it 85.40, 85.60. So that was my first target, and second target is basically 92 plus. So that's on the technical side. It's a beautiful chart. It came back. It came back a little bit on lower volume, then it returned back towards mid 80s, then it pulled back, made a higher low, and now it's returning again. And consumer staples generally are outperforming today. I mean, for example, here's XLP. This is consumer staple sector as a whole, and you can tell how beautiful chart this is because unlike the rest of the tech sector or biotech sector, this thing is holding in a very tight bull flag. This is XLP I'm talking about. It's holding in a bull flag near 52-week high. We're already long call options in Procter & Gamble as well. I'm looking for XLP to break out again from this bull flag and make another 3 to 4% run to the upside. And so in that scenario, I believe EPC will also perform well with the rest of the group. So here's the technicals, right? And on the option side, this is where it gets a little bit interesting. Note, first of all, there's not much open interest anywhere in the option chain. I mean, you're not going to see much on the calls, on the put side, definitely. But on the call side, note there is 7,500 open interest sitting in August, 90 strike calls. With the stock at 83, there is 7,500 open interest sitting in August, 90 strike calls. To show you exactly what happened there, this is all you have to do. Right click here. Go here, go to and pull up the chart of actual option activity itself, which is right here, and you're going to see they came on May 2nd and they bought these calls. So give you more direct thought about that. So let's take a look at this. May 2nd, let me pull this up, and I'm going to show you in just a second, pulling it from my different screen right here. So on May 2nd, this is May 2nd, and I'm scanning. Let's do this. Let's scan for all lot sizes above 50 contracts. And so you're going to see they bought about 2,400 contracts of the August 90 calls for 260 to 265. These were bought on the offer. There was wide bid and ask spread, and they bought them on May 2nd. By the way, do you know what May 2nd was? May 2nd was the day when the earnings came out the last time. So on the day after the company announced earnings, they came and the bulls were buying, they bought approximately, let's call it about $500,000 worth of calls that day on May 2nd. Then this is right here on May 18. The return on May 18, if I simply turn this into, pull up May 18, you'll see it. Right here, there was a large call roll that time. they closed May 90 calls and they rolled them to August 90 calls. And the August 90 calls at that time were bought for $1, also above the offer. All right. So basically, you got about 7,500 contracts that are holding in this August 90 strike calls. They were bought for as low as $1 to as high as $2.65, and they're holding in this open interest at August 90 strike calls. And then today, they're coming for November 90 strike calls. Over 900 contracts bought today. To show you quickly, a block of 750 contracts of that was bought today for $3.20 offer side, when the bid and ask spread on this was very wide, 220 times 320. So $1 wide, $1 wide bid and ask spread, and they came out and they bought 750 contracts of that at 320 offer. To quickly show you the math, that is approximately $240,000 bullish bet. That's looking out to November, and once again, with the stock trading at 82.27, this is about what, 10% out of money calls. It's the break-even point on this is going to be about 12 to 13%. So the point is that both in August and November, not so much activity to see in July. That's probably because we don't have a catalyst in July. Our earnings don't come out until August. But as far as August and November is concerned, we're seeing pretty good size call accumulation since early May, the day the company reported earnings. Back to the chart. Here's the EPS chart. So right here is right here is when the company reported earnings on May 2nd. The stock did gap higher, but then it returned back to high, and we continue to see steady accumulation since then. And these bulls are looking for a breakout. Now, so that's my technical view. We're looking for 85.40. That's my first target. Second target would be 92 and change. And we got fairly big amount of call option activity taking place, accumulation in August and November. Now, on the fundamental side, now, one thing I'm going to tell you, and this is where, a lot of the times we discuss something in the chat room and we record our information, we take a good detailed view of the fundamentals, and then it may take sometimes immediately, or sometimes it may take months and a long time for the case that was laid out a long time ago to finally come to fruition. So in this particular case, I'm going to actually pull something from way back when, from May 2015, from a year ago, to show you something I said way back then that just might now become applicable. To quickly let you know, by the way, Edgewell Personal Care, the company, makes all kinds of wet shaving products, mostly for females, mostly for women. So, all kinds of shaving products, all kinds of things that women use, that's their basically bread and butter. This is about 60% of the total sales come from that particular category. And that category at this particular time, this Edgewell Personal Care is the market leader in that. They have other product lines as well, but that's the biggest one, the wet shaving products for female. All right. Now, Edgewell was spun off from Energizer Holdings way back in May 2015. Energizer Holdings stock is ENR is the symbol, which is right here. And as you can tell, this stock has been ripping higher. This is also consumer staple. It's been going higher nonstop ever since the company spun off Edgewell Personal Care. I believe now it's time for Edgewell to perform as well. There was no reason why it was under the umbrella of the same company. A battery maker such as Energizer and Edgewell Personal Care were all part of the same company. I understand they're all consumer staples, but there was just no synergies to be had between the two companies. Very different type of product lines and whatnot, and now these two companies are separated. So, back in here's an interesting thing that I mentioned back in. These are my notes. Go back to, you can pull this up, by the way, in the activity tracker. Here's something I want to show. If you go to my notes, look what I said right over here on May 26, 2015. Worried about a takeover offer immediately appearing after the company splits into two entities, one focused on household products and one on personal care products. And then it goes on to say, the plan is designed to assist the board in the period leading up to and immediately following the separation and protecting against creeping accumulations or other share acquisition activity. What the heck am I talking about here? Let me tell you this. Back in May and June of last year, Energizer, before it spun off Edgewell Personal Care, EPC, Energizer board was so worried about an immediate and imminent takeover bid for the EPC, for the Edgewell Personal Care product division, that they were so worried about this immediately after the spin off that that the board at the time decided to adopt a poison pill. I discussed it right here in July 6th. If you go over here, you look at this. A poison pill, also called shareholders' right plan, is basically a plan that the board adopts in order to stop any kind of hostile takeover of the company. The board of Energizer was so worried that this was going to happen no matter what, and there was a lot of chatter back then as well, that they adopted the poison pill, which basically kind of pushed away any kind of M&A deals that was going to take place. And that's where the story started. Now these two companies have, both of them are separate. Okay, they've gone their own ways. The separation has taken place, and on top of it, the poison pill that was adopted back then is no longer applicable. It's now removed. There's not in place anymore. So, going back to the EPC chart, does that mean that now that that hangover is lifted, it is more of a buyout candidate? I think that's exactly what you're going to see. What you're going to see. This is about $4.6 billion consumer staples. It's not hard to digest. Procter & Gamble can come out tomorrow. Procter & Gamble does not have a huge presence with their Gillette brands and everything. Procter & Gamble does not has the moat or has the leadership scale when it comes to wet shaving products, especially in the feminine category. They can come out here and buy Edgewell for, it's a $4.6 billion company, and then they will control the entire market. The same thing can happen with other forms of consumer staples that can step in and actually get it and acquire the company. Here's something I want to show you from RBC Capital. This is from May 31st. All right, this is after the analyst attended the Consumer and Retail Conference on May 31st. I'm going to quickly search and take you to where they had discussion on EPC. Okay, right here. This is on May 31st, page 17. Right here is what you need to pay attention. We see HPC and beverage names continuing to engage in tuck-in M&A through the back half of 2016 with the potential for some to do more transformational M&A. Right here. One example is Newell Brands, which on the heels of Jarden acquisition remains a top pick. We also remain of the view that Edgewell Personal Care is still likely a takeout candidate. We believe EPC, particularly its wet shave business, is a scarce asset with a long list of potential strategic buyers. For EPC, we continue to believe there's an 80% likelihood of a takeout in the next 12 months, justifying our $111 price target. There you go. Right there is the meat of what they came out. This was on May 31st at the Consumer and Retail Conference. After they listened to the management presentation, this is exactly what the takeaway was from the conference. They believe that EPC will get acquired in the next 12 months. They assign 80% likelihood to that scenario, and they believe that the wet shave business, especially in feminine category, is a unique asset with scarcity. And it's a $4.6 billion market cap, and it's easy tuck-in acquisition for somebody like firms like Procter & Gamble, which we're also long, or really for all other kinds of companies such as Newell, Rubbermaid, Jarden, or anybody. So there's that. All right. Now, last thing I will mention on the fundamental side of the things, the company reported earnings, and I'm pulling that data right now. The company reported earnings on February 3rd. Before what happened over here, all around over here, and I'm going to quickly walk you through this. The expectations, while the actual wet shave business has been growing at about 4 to 6% at an annual rate, the rest of the business, which is 40% of the business, has been pulling those sales down, keeping a lid on the total sales growth to no more than 1 to 2% annual growth. This may not seem very exciting, right? But the trend changed a little bit. but the trend changed a little bit. Last quarter, as reported on in the first in early 20 in early February, and then once again in the February, in May, the company beat on top and bottom line estimates. The EPS came in at 68 cents versus 60 cents estimates. The revenues were 495 million versus 479 million. But the reason why the stock gapped down, just to kind of quickly let you know, the reason why the stock gapped down right here and then recovered immediately was because the chairman of the board stepped down. The chairman of the board stepped down, and now we have a new chairman on the board. This caused a little bit of concerns among the analyst community that perhaps that means no M&A coming. I take the other view. I say that that's probably exactly what was needed to get some sort of M&A started. Okay, so because now you have a change in leadership as well, the same leadership that was carried over from Energizer before the split of the company. So perhaps this change in the leadership was necessary to now make the room for M&A going forward. So here's the bottom line. The catalyst that I'm going after is August earnings, or earnings in August, which is going to be sometime late July or early August. We don't know the firm date yet because the company has not confirmed. So basically, I want to buy the call options, August 80 call options. That's my recommendation here. August 85 call options. Go buy those call options, put them away, and we're buying them for earnings. Technically, the stock is breaking out. The first target is 85.42 or 85.40, and the second target is all the way to 90. And we got bullish call activity taking place consistently since early May, in targeting way out of money 90 strike calls in August and November. If there is an M&A, I'm really buying it for earnings because I expect this thing is going to break out. But if there is an M&A, that's just all icing in the cake. Who knows? This stock may open at $100. One day you'll wake up in the morning, you'll come and turn your computer on, you'll find out, oh, the stock is trading at 100 plus. Why? Because it just got acquired. So that's my bullish view.